Okay, so we are broadcasting on Facebook. We just opened up the webinar here in Zoom. Participants are rolling in to today's webinar. Eileen, thank you again for joining us. I'm going to let people trickle in a little bit. We'll get you on screen. I think I'm going to want everyone to learn a little bit more about you, and then we'll get into the presentation you had prepared today.
Fantastic, Jasmine. Thanks so much. I'm excited to be here.
We're excited to have you. Especially excited to have you because you are a member of the New Jersey Tech Council too, right?
Absolutely. I joined last summer and I grew up in New Jersey. So this was a really interesting organization to get involved in. I think we hear a lot about advances in the Silicon Valley, but meanwhile here at home in New Jersey, there's still an outrageous amount of creativity and commerce and entrepreneurship happening right in our own backyard. And I think the Tech Council really embodies and epitomizes that. And there's just strong collaboration across disciplines to put forth good ideas that can have an impact on society and enhance the way we do business, the way we communicate, and the way we build connectivity.
For sure, absolutely. Love hearing all of that. You're definitely right. I have to say we agree.
Yeah, I've made some great relationships too. It's been wonderful to get to know you and Aaron, and the Propelify conference was stellar. There's always a really good turnout there. And I feel like you guys have built tremendous community. And when I go to council events, I can tell that I'm surrounded by folks of like mind. I take a great deal of comfort in that and you know, feel very enthusiastic about the opportunities that you present to all of us who are members.
Good. Well, I'm glad to hear all that. We are constantly trying to provide, new value, new experiences for you all. That's part of why I came on to the council overall myself. So want to get into this. We've got about 45 minutes for you to share, a couple decades worth of insight with us. No big deal at all. For those of you, this is your first time tuning in, I'm Jasmine Hoff, and I'm the head of experience at the New Jersey Tech Council, which is an organization that supports and propels technology in the state of New Jersey. You want to learn more about us, NJTC.org is the place to go, and we'll help you out. This is our lunch and our webinar on the state of the economy, and Eileen is going to be sharing with us some data and insights from her firm, Alliance Bernstein. For those of you that have questions during her presentation, I encourage you to put them in the Q&A, which I'll be keeping tabs on and working those questions into the conversation. And if you want to chime in where you're tuning in from, any other insights, you want to just share some thoughts, feel free to put them in the chat. We'll be keeping an eye on both of those, and I'll be moderating those as Eileen gives her presentation. But Eileen, thank you again for joining us. Will you just share a little bit about yourself with the audience?
Yeah, absolutely. So I grew up in Glen Rock, New Jersey, in Bergen County. I reside currently in Philadelphia, and I'm helping lead Bernstein's practice in New Jersey. My father is one of those dads who commuted into Wall Street every day to provide for our family. So I got exposure to it early and often, whether it was take your daughter to work day. My uncles got me interested in investing early, just the importance of squirreling away money and having your money work for you while you sleep. Just the importance of, money in our family was not meant to be idolized, not meant to be flaunted, and also not meant to be hoarded. It was really a balance between lifestyle and security. Like many families in America, my heritage was immigrants, and we had a family closely held business, which, like many closely held family businesses, didn't make it to the third generation. So my parents had other jobs outside of the business that my great grandparents had. And it's interesting, your heritage. I also have the privilege of having had a famous aunt, Gertrude Ederle, who was a professional swimmer, and she was the first woman to swim the English Channel. So having a professional athlete in your family is also interesting, and just seeing, how that impacted us, and just the importance, again, of investing and thinking about the next generation. I always really liked math, so that put me kind of in a position to pursue finance as a career, and I've been very, very lucky. Again, living in North Jersey, had the opportunity to start in the business in 2006 at Citigroup and JP Morgan. I've had experience. I had the opportunity to work at Goldman Sachs for 7 years in the asset management division, which was a phenomenal experience, really focusing on economics and risk-adjusted returns and all of those interesting concepts that help us be successful when it comes to investing. And that ultimately led me to AB Bernstein, where I'm in the private wealth group. And our tagline is making money meaningful. So I think that that is a really great way to earn a living and hopefully leave an impact on my clients who are my motivation.
Okay, excellent. And who are the types of clients that you work with, for those of us that aren't as familiar?
So Alliance Bernstein is the 16th largest money manager. We're a global boutique. We have offices 51 cities across the world, but our sole focus is research and money management. That's the only way we drive revenue. So we take what we do for a living very, very seriously. We've been around for over 50 years. And the types of clients I work with tend to have unique complexity. At the end of the day, it's all about our clients. We wouldn't have a business without them. Right. So we're there to help them solve some of their stickiest challenges. So the focus of my practice is corporate executives who tend to have interesting equity-based compensation that can leave them overexposed to, a certain allocation, interesting liquidity needs, also business owners. So folks who are having unique success scaling their business or anticipating an exit or thinking about succession planning. And then lastly, global families. I think, unfortunately, this pandemic has amplified for us more than ever the reality that we do live in a global society, and the opportunities abound today for folks to have opportunities to work abroad. But oftentimes that creates interesting currency and cross-border tax issues. So the more challenging the circumstance, we feel the more meaningful our research and our analytics can be in helping our clients have confidence and clarity so that they can be empowered to live the life that they want.
Got it. Okay. So with that, then I'm going to turn you over to your presentation, which I know you've spent quite a bit of time preparing. I know we've been talking about this for weeks, so I will let you get into it, and I'll be here again, keeping an eye on questions, keep an eye on Q&A, so that if people want to chime in, I can help.
Yeah, absolutely. So we've come a long way from the beginning of the year when we were just seeing news reports coming out of China and reacted to those. So I just want to give a brief synopsis of what we've experienced, what our advice is, and where we can go from here. A lot of the uncertainty remains, and it's really hard to accurately predict the future when we still have so many unknowables. Obviously, the duration of the virus is something we were tracking closely. It was really encouraging to see the flattening of the curve, at least locally, domestically in New York, come mid-April, seeing that success. Just earlier this week, we saw some good news from Dr. Fauci and Gilead about some positive data out of the remdesivir trials, which is great. And obviously the success of social distancing. So what we want to emphasize, though, is that bull markets are born out of bear markets. And we certainly experienced that last month. And so our advice to investors is ultimately to stay the course. So from here, I just want to give you a quick preview of what we experienced and help you internalize that from March. So traditionally, we learn from our parents, we learn from our professional advisors. And if I can draw your eyes to this gray part of the circle, the average number of weeks that an investor tends to go before experiencing what's considered a bear market, a 20% correction, is 106 weeks. So that's roughly every 2 years, we're expected to have this type of volatility. Meanwhile, following the great financial crisis, what we know is that we went literally 11 years before experiencing a bear market. That is outstanding. And a lot of trends developed over the last decade. Significantly, one of those was the move to passive management versus active management. So on February 19th, we saw the market top out at the S&P I'm referencing is 3386. And from there, within a matter of weeks, we don't know if we've bottomed. We certainly could retest bottoms, but we bottomed as of now on March 23rd at 2237. So since then, we've recovered significantly. We're back to August 2012 levels, which is encouraging, right? And at this point, we're only down roughly 9% year to date, which is correction territory, but no longer bear market territory, which is really encouraging for our clients and for investors overall. The yield curve, which is something that we watch very, very closely and signifies what we call a flight to quality in my business. So moving from riskier equities to safe haven assets like treasuries. Right. So a year ago, across the yield curve, we saw interest rates much higher. The Federal Reserve's monetary policy has brought interest rates to rock bottom lows. So that's where we stand today across the yield curve. And I want to underscore just how severe the volatility we experienced was in the market. We track an index called the VIX that tracks volatility, and that reached 85% in March. We're back down to roughly 35% on that. But another way of considering it is the chart on the left shows, in 2019 alone, there were only 5 single days where the market traded in a range above 2%. Through the end of March, we were 3 months, only 1 quarter into the year, and we'd already experienced 14 days. On the right, I wanted to give everybody an update, since typically as an investor, you probably hold more than a handful of stocks. You probably own a diversified portfolio. And the result,
should, right?
yeah, hopefully, if you're getting good advice. But the reason for diversification is because different asset classes experience or deliver different behavior over various courses. And since we can never predict exactly what's going to happen, it's important to balance a portfolio. But what we're showing here is that across a variety of asset classes, there was very, very different outcomes. And so as of today, I'm just going to give you a quote. Forgive me if this is a little long, but just where do we stand at this moment in time, May 1st? So year to date, the S&P 500 is down 9.3%. Growth as a style is only down 1.5%, whereas value is down over 18%. Small caps have struggled, they're down 21%. Emerging market equities are down 16.5%. Emerging debt is down 12%. Developed international markets, so thinking about Asia, Europe, those are down 18% still. And global equities more broadly are down 12%. So, those are the green aspects of the chart right there. And then bonds, which again are risk mitigating assets in a portfolio, we've seen some dislocation there, and high yield corporate bonds are still down 9%. Municipal bonds, core has recovered a little bit, but high yield municipal bonds are still in negative territory. So there's been a variety of performance across. And so if you're watching television and you see what's happening on the S&P, that's probably unlikely reflected in your portfolio.
I do have a question.
Oh, sure.
All right. So the question is, and I just got in the Q&A and reminding everyone to put your questions in there. What are your thoughts on currency hedging, international equity allocation, given that the dollar usually gains during stock market worldwide panic?
So that is certainly a tactical play. And if you can implement it, it can tend to enhance your short-term returns. But for most of our investors, we think of them as long-term investors. And so while our portfolio managers might be putting on currency hedges in portfolios, those come at a cost. Right. And you're also expecting, you're essentially taking a bet. And how long you keep those trades on is a reflection of, where you think things are going. So certainly we anticipate the ability to benefit from trends that we can anticipate. But over the long run, currency hedging can sometimes be costly, and it's challenging to add value there. So it really depends on the skill of the manager and the duration of that trend, because it can be costly to get out of. So that's what we would say.
Okay, cool.
One of the things that we talk about a lot is how risk management assets, bonds in a portfolio, are supposed to dampen risk. But what we saw coming into this was a lot of forced selling. There was leverage in the system. So interest rates have been very low for a very long time. And a number of market participants had borrowed on margin. And as the value of their portfolios declined, they had to meet margin calls. And in order to meet those margin calls, they were put in motion forced selling situations. And since the great financial crisis, dealer inventories are no longer available to be purchasers of bonds that are being sold. So punchline is there were a lot of sellers, not enough buyers. Luckily, the Fed stepped in and acted as a buyer of last resort. But what we're showing here on the left is just that, even the safest assets, treasuries, tended to see a huge spike in volatility. On the right-hand side, what we're dimensioning is the muni odd lot penalty, which is the cost of somebody looking to sell $1 million worth of munis. Where traders usually meet is between the bid and the ask and where they negotiate, and that tends to be roughly 1%. But for a trader looking to offload less than $1 million worth of municipal bonds, it was very, very challenging to find liquidity. And there's still a huge haircut, we would say. The prices gapped out, and folks looking to sell into that market likely saw a significant loss on the sale of a less than $1 million type of transaction. So now that we have a little bit of context for what occurred through March and early April, what I wanted to mention was, where do we go from here and what's priced into the markets? I think that's something we're all thinking a lot about. Investors tend to insert their emotions, and when we make investment decisions, we make them from a basis of confidence or of concern. And everybody, again, has their own unique circumstances and perspective. And so what we wanted to give you was a framework and a set of assumptions under which you could decide whether you were optimistic or pessimistic to enhance your own ability to make investment decisions at this point in the cycle. What we want to point out is that we do believe that there are better days ahead. A big difference is that this was an exogenous event. We've heard a lot over the past couple of weeks that we are all in this together. This was, above all things, a health crisis. And we're tracking a lot of high frequency economic indicators to signal to us when we think we can return to whatever the new normal looks like. And then lastly, the third question we've been getting from our clients is, are we still on track? And any good advisor who's helping their clients initiate a financial plan is going to do some forecasting to take into consideration a varied amount of market conditions. So we'll show that to you. So I'm not going to belabor this chart. We know now as of this week that GDP is contracting by about 4.8% annualized. But on the left-hand side, what we were posturing before this print came out was how drastic the consumption spending was going to decline. And AB's forecast said negative 20% for quarter over quarter growth. Some forecasts and consensus suggested a 40% decline. So how we annualized that was taking negative 0.2 multiplied by 3 months, which is a quarter of a year, got you to roughly negative 5% in GDP. But I want to underscore that these forecasts are going to evolve, because just because we are seeing some positive signs about the ability to reopen the economy through the multiple phases that the administration has laid before us, we don't know how quickly people are going to really get back to spending money in the ways that they were prior. So forecasts can certainly be amended.
Let me ask you something. Do you think that this event overall, all of the impact that this COVID-19 pandemic has generated, will leave a lasting impression and change on consumer spending or investment practices overall? Like, do you think it will ever go back to the way things were? Do you think, generally speaking, people will either drastically or even slightly just tailor their spending and their investment habits?
Everything is very driven by somebody's unique circumstances. If you've been furloughed or laid off and are now receiving, some of the fiscal stimulus or unemployment from your state, your ability to take that vacation, even though I think on the back end of this, all of us would love to take a vacation. Right. Those are going to be dictated by everybody's unique financial means. Right. I'll come to this in one of the further slides, but after every major financial crisis, whatever the cause, we have an outstandingly resilient society. And that's just, I think, humanity speaking. So all the academics we have that support the principles of investing, that we want to be compensated for risk, that we want to watch our money grow on our behalf, that we need to combat inflation to preserve purchasing power so that when we're in retirement, we can enjoy the lifestyle that we desire. Those principles are not likely to change. I definitely think there will be trends and lasting impacts in terms of how business is done, the demand for me needing to take a train up to New York to necessarily meet in person, the hour commute there, the 2-hour commute there and back, whether that will be as necessary. Some of this remote working has actually made us more productive. So things like real estate strategy, open floor plans, those type of remote work environment benefits, and even the benefits to the environment, quite frankly, might have lasting impact, certainly. So we're doing research on that. We
Yeah.
continue to produce research on that. And I think it depends how quickly we get back. But again, everybody's circumstances are very unique to them and what they can afford.
Of course. Okay.
So another question we're getting is the strength of the banking system. And is this another '08? So quite frankly, the recession we're facing today is far more significant than what we faced in 2008. But in 2008, the wheels of the economy seized up. And a lot of the regulation post-financial crisis was set in motion to improve the safety and the health of the banking system. And in this circumstance, the banking system through the Small Business Administration has been the conduit to the relief that bipartisanship allowed. So what we're just showing here is that the capital in the system is higher quality. There's less leverage in the system. The loan to deposit ratio is lower. The interbank loan ratio is lower, whereas deposits are higher. Consumers have improved their savings rate in a significant way after being caught off guard in the great financial crisis. So banks have really improved the way they do business, and this is not what we see as being a systemic risk. So this is my favorite chart, because what we're showing here is a plethora of data from 10 sell-offs since World War II. And what we show, and if I could draw your eyes to the bottom of the page, is I'm going to talk in averages, right? You can take in this information, but typically it takes roughly 16 months from the peak to the trough. We know we essentially at this point saw it in potentially 3 weeks. And if you think about 16 months, that's almost a year and a half. Again, thinking back about behavioral finance, how hard it is over a long period of time to watch your money decline. That's why it's so important to stick to a plan. And typically that peak to trough can be, down and on average about 34%, which is exactly what we just experienced. But the recovery tends to take roughly 34 months. So that's almost 3 years to climb back out, which again, if you're doing ongoing investing, take your 401k, for example, if you can still afford to be contributing, you're legging in at prices that were lower than February 19th, which is, and again, while your money looks smaller in terms of principal in the account, if you're continuing to invest throughout the recovery, you're actually getting in at more attractive prices. And we can't emphasize enough, and we literally experienced this in March, that the correction, the return following the trough tends to be equally as robust and violent off the bottom, and that days of significant corrections are paired with days of robust returns. And trying to time the market during those clusters is often a fool's errand. So we certainly could test new bottoms, and that's what we're sharing here. So a run-of-the-mill recession typically means a 15% earnings decline. We came into 2020 expecting 8% earnings growth, and the price to earnings multiple, a forward-looking multiple, was roughly 18 times earnings at that point. Now that we've felt a significant amount of the pain, the market is a discounting mechanism. It's priced in a lot of the earnings. We're in earnings season right now. We're seeing some winners, we're seeing some losers, but what we are doing is looking forward, because stocks are a long-term play. It's for investors who are looking to build wealth over the long run. So what we're just simply saying here is that consensus is seeing improvement in 2021. And we expect, the S&P is roughly down, like I said, 9% year to date, with an implied multiple of 17 times. So it's up to you to decide, in order to experience, a 50% decline in the market, somebody would have to expect a much more severe decline in earnings and severe multiple contraction. So again, the bull case is that we, have experienced the worst, that we get back to work in a meaningful way, that as you just described, people get back to going to malls, going to restaurants, living the life that they were enjoying prior to the crisis. But the bear case is essentially that while this recession lasted 1 quarter, if we see challenges coming back in at the end of the summer or a resurgence in the fall, what that could mean. And it just could take longer for our economy to heal. And none of us truly know the answer to that. But the longer stores remain closed and employees remain out of work, that challenges real estate, property taxes, sales taxes. We've seen the federal deficit expand to wartime levels. And that's just the US. We came into this in a very stable position. Our expectation for growth coming into this year, our economist, Eric Winograd, was anticipating 1.5% growth rate. Again, we just said through the first quarter, we experienced, a 4.8% decline. So that's over a 6% decline from where we anticipated we would go. And again, we're probably likely to see more upsetting economic data, but whether the market, because it's a forward-looking mechanism, is going to struggle as a result of that data remains to be seen. So I think this is a really interesting chart because you can decide for yourself what you believe is fair value and when you would be willing to buy in.
So do you mind if I pepper in a question?
Of course.
Here? So I have two different questions about cryptocurrency. They're similar. So the question is, we've seen some dramatic moves in gold, oil, Bitcoin, cryptocurrencies. And obviously there's quite a bit of volatility in individual types of investments. What are your thoughts on these moves and I guess those general categories of investment?
Yeah, absolutely. I think our belief, and we put out a podcast on this a couple months ago, should you buy gold? And I think our, gold tends to be rewarded in an inflationary environment because it's a real asset. Right. And, while people are talking about that there could be inflation because we're printing money here, there's obviously always going to be volatility, but in terms of the size that gold plays and oil as well in a portfolio tend to be on the smaller side. I don't want to pretend that I'm an expert in cryptocurrency. I'm not. It's certainly an asset class. And I don't feel comfortable commenting on, where cryptocurrency is going because that's not an area of academic study for me. Right. But as far as volatile asset classes like gold and oil, again, real assets tend to benefit a portfolio when inflation is rampant. And quite frankly, if we just use the great financial crisis as a proxy, there was tremendous stimulus. I'm going to show it on another slide, inserted into the economy then. We've had benign inflation since then. So while inflation is very much an academic thing that we talk about, whether in reality it rears its head isn't necessarily as ominous or threatening as we maybe learned in school. So I hope that answers the question. There certainly could be considered, again, if you're a portfolio manager and you're using these assets to be opportunistic when they trade at attractive levels, right. Anything is a good entry point, but how you size them in portfolios, I would say they don't tend to be the largest allocations.
Got it. That makes a lot of sense. And I have one more question and then I'll let you get back to your chart. So we've got another question is, how do you see industrial buying performing in these scenarios? And I think there's a follow-up comment of just in B2B businesses.
We actually like industrials right now. We think there's opportunity there. Just the way that vendors are, negotiating transactions because of some of the spending and the stimulus, that tends to present opportunity. We know in crises past, when stimulus is passed, industrials tend to outperform. So we do like that sector. Obviously, though, I caveat that by saying it depends company to company. I made reference to passive management at the beginning of this call. And I think there is more winners and losers. And so what we would tend to look for in a company is high quality, enduring businesses that have the ability to generate cash flow regardless of a environment that requires sheltering. So we would be looking for companies that have strong balance sheets and could remain prosperous regardless, but we do like the sector.
Great, thank you.
So I won't belabor this, but there was a temptation at the beginning of the quarantine to compare ourselves to China, who had a militaristic style shelter at home. The US is a country that values its freedom immensely. And so while it was a policy to save lives that encouraged us to stay at home that we enacted here, it was less severe than the way China implemented things. And I think we were also tempted to compare ourselves to South Korea, where they had testing out front very quickly. So it wasn't really an apples to apples comparison, but it was very encouraging in early April to see that the sheltering in place and the social distance mandate to prevent recurrence and save lives was starting to work. So we're using this data to dictate the ability to reopen our economy. And I talked about high frequency economic indicators. Before the crisis, again, we'll use China because it was a first in, first out example. They are seeing huge patterns that we can maybe anticipate following. So prior to the beginning, migration patterns were high, energy consumption, there's still a big coal consumption. So we use it as a proxy for energy and electricity here in the US. That dipped significantly and essentially flattened. But what we saw is now that they've reemerged, traffic has kind of gone back to normal. But the question of whether people are going to be comfortable riding the subways, you asked a question, will consumption and behaviors go back to normal? Very, very uncertain. It might take a much longer period of time for that to get back to a level of pre-pandemic. So again, using China as a proxy, what we're showing here in the dark green is that 95 to 100% of resumption of activities. We know that China is a manufacturing heavy economy, and it's really more that Hubei province that it was experiencing a slower return. But even now, as we promote this, they've experienced a significant recovery, which gives us hope here. And another thing we're tracking, again, it's not pictured here, but our economists are looking at things like credit card usage and airline usage and energy usage, as we showed on the last page, as proxies for our economy opening back up. And as we also think about where the stock market might go, we look at something that's called short interest in names or sectors, which is traders' prediction, from a tactical perspective, that there might be more weakness to come in a certain sector. And to the points of the person talking about currency and industrials, where is their strength and where is their weakness, and how permanent and how enduring will those challenges be? Wall Street market makers have opinions on these trends and they take action in them in portfolios. So we also try to track short interest, in terms of participants on Wall Street. And that tends to lead to more volatility as well, which was, again, part of what we experienced.
What about some of the long-term impacts on the Main Street businesses? So retailers, restaurants, leisure, there's obviously a massive impact here. And some of those organizations, because they are oftentimes family owned or they're smaller businesses, they don't have that same larger corporate structure to bail them out or potentially give some financial support. What, either in your or the firm's opinion, is going to be happening to those particular sectors?
Can I table that for 2 slides from now?
Yes.
Because we actually have a chart for it, so I don't want to ignore it, but something that is giving tremendous anxiety, and we talk about economic data getting worse before it gets better, the unemployment rate has skyrocketed. We are now, as of this week, 30 million Americans having applied for unemployment. That far exceeds what we experienced in the great financial crisis. That was over 15 million. And we're currently at 15% unemployment as an economy. So this is the highest level that we have experienced since 1934. And we expect employment to recover. As I showed on another slide, we're optimistic about the growth that we can anticipate in 2020, being roughly 3%. So we do anticipate putting people back to work. And again, the cause for this unemployment was not some systemic issue where there was a blow up in a certain sector. Certainly sectors in hospitality and retail and airlines will be slower to recover simply on the basis of our ability to be close to one another in those type of settings. But the ability and the purpose of the stimulus package that was passed by our administration in a very swift bipartisan effort was to keep people employed, right? Perhaps to keep them furloughed and maintain their benefits. We saw banks allowing deferral or forbearance on mortgage payments so that people could keep their homes, which is, again, a very different experience than people who lost their homes in the great financial crisis. So this was a policy move that was done to save lives. And the expectation is that we slowly get back to full unemployment, and the Fed has committed to keeping interest rates low until we get back to full employment. So hopefully by the end of the year, we're closer to a 10% or 7% unemployment rate. That's still a far cry from the 4.4% we came into this crisis with as of February. So somebody asked about energy earlier. Energy is an input to many, many things. We're not driving, we're not flying. Obviously, it's a demand-driven commodity, and we don't have the demand for it right now. So there's an oversupply, and when there's an oversupply, prices fall. So we think this could be a silver lining to consumers who want to get back to normal. Maybe if we're allowed to drive to the shore, we have to wait to see what those policies really are. But there are some silver linings here. Again, the Fed is committed to keeping interest rates low, which is intended to stimulate growth so that small businesses can borrow and they can look to expand and open new stores or new franchises or create new products that they know that their market will consume. We talked about inflation a little bit already, that academically, when the Fed prints money, that there is always a risk of inflation. But we're at the New Jersey Tech Council, and I think something that we probably can acknowledge is that technology has actually been a secular trend that has kept prices lower for longer. So we also need to be we've heard, other Fed chairs, Janet Yellen used to talk a lot about slack in the economy. And at this level of unemployment, I don't think most people are expecting to get a raise, right? So when somebody gets a raise because your company is hoping to keep you on staff and they want you to stay at this company versus go to the next company who's going to pay you a little bit more, they have to raise your wage. And wage inflation is a huge component of inflation overall. So while we have unemployed people, it's not likely that people are getting raises this year. We've seen tremendous fiscal stimulus. And again, this was an exogenous event that was health related and pandemic driven, as opposed to a systemic risk. So a stable economy entering the downturn. I mean, I don't know if we can call it a V shape. Our economist has been talking about a reverse check mark, but that really bodes well for people who are hopefully going to get to return to work to some degree.
Right.
So there's been 5 channels of monitoring and measuring the policy response. Obviously, getting the health funding is of primary importance to support those that are on the front line. But everywhere else, seeing the financial system supported again. The Fed stepped in during March when there was tremendous illiquidity. They stepped in to buy treasuries, AAA corporates. They stepped into the mortgage space. They stepped into the municipal bond market and agreed to actually expand that program a little bit further out off the curve. We've probably heard some folks talk about, our state's going to default. We don't think that that's likely. I'll talk more about that later. But I want to emphasize that financial system support, that wasn't a bailout. That was providing liquidity so that the markets could, in fact, function. It was a stabilizing factor, and it was very, very important. And then, of course, the fiscal stimulus, which the question you asked earlier is what's being done to help Main Street companies, right? If I'm remembering.
Yeah, restaurants, leisure, you've got airlines, hospitality, like that industry definitely is taking a considerable hit. I'm wondering if you think they're going to rebound at the same rates that historically, like the market itself has rebounded.
In this circumstance, likely not, because there's just fear in our society today that even if a restaurant opens, again, you just have to ask yourself that question. And I'm looking at the two of us, and am I in a demographic with comorbidities or health challenges where I think I'm likely to be at risk? Only we know that about our own health. And, that will dictate who's willing to go back to what venues and how likely I am to fly to Florida for a vacation on spring break when I have the ability to. So that's a really hard question to answer. And I think, some of the headlines we've seen this week as it relates to improved testing and encouraging the ability to be able to trace
Right.
contact is going, as we've seen that accelerate and we get more firm guidance from our administration on how to enact those things, that's going to provide consumers much more confident to feel comfortable going back into circumstances that at this point are still deemed relatively risky. So I think that's the balance, and the sooner we can get positive guidance from the administration on testing and tracing, that'll help. But again, I'm not going to articulate every Fed program here, but the punchline is that it was substantial. And in combination with monetary policy, not seen since wartime levels, we've also seen tremendous fiscal stimulus. And it amounts to roughly 10% of GDP. The direct checks to individuals, the unemployment benefits for folks who have been laid off, so that again, you can pay your utility bill, you can feed your family. They've eliminated student loan interest for the time being. So those fiscal programs were intended, it was called the Paycheck Protection Program for a reason. Right. And I know that the longer we stay sheltered, the more challenging it is to get those things, but the mandate was to keep folks going for 8 weeks. So that's really important. But what I want to highlight here is that the speed with which the administration acted was unprecedented. If we look at back in the financial crisis, it took almost 4 years to get 1.5 trillion in stimulus passed. Meanwhile, people worked across the aisle and they got these stimulus packages passed so that we could get relief to our citizens, which the speed with which this was enacted was unprecedented, and it really helped make sure that the damage wasn't too permanent. And that's the focus of what they delivered. The magnitude is outstanding. So coming to, if somebody is an investor, are they still on track? And obviously everything depends on how long you've been an investor and when you enacted your financial plan, but we model for this. So our clients, we didn't know it was going to be the coronavirus, but where their principal, where their account balance is at right now was in our forecast. We always look to see, it's great to be optimistic. So you hope for the best, but you plan for the worst. And yeah. Hostile markets, we think of persistent low return environments, challenging inflation, and living a long time, the fear of whether you'll outlive your money and whether it will keep up with you as you need it. So we took this into account, which provides a significant amount of comfort to our clients. Again, depending on how old you are and how far you are to retirement or what your other objectives are, you might still feel anxiety, but that's why it's appropriate to have different asset allocations depending on your goals. So we give our clients the opportunity to understand what the risk is to having to live through a bear market. And again, correction is 10%, a bear market is 20%. What we just went through was a 30% correction. But again, we've bounced back relatively quickly. Depending on what style investor you are, it's roughly a 34% probability that over a 2-decade period, you'll experience a bear market. And it's even doubly as likely if you're a growth investor. So again, the younger you are, the more growthy your portfolio may look, depending on your risk tolerance, but we try to help our clients understand the likelihood that they have to deal with something like this so that they can prepare themselves. A lot of our job is managing expectations so that when the worst happens, which we felt like this was the worst, that you can maintain the mental state to stick to your plan. And that's exactly what we show here, that de-risking a portfolio, pulling to cash, that doesn't mean making some changes to different stocks on the margin. That's not what I'm talking about here. But what we're showing is somebody who was in retirement, who was in an aggressive growth allocation, somebody who was in a more conservative allocation, and that in 2009, when they had to endure the pain of watching their portfolio slowly decline and watching again those negative headlines as it relates to the economy, the fear that that creates in an investor that tempts them to pull to cash, well, we show the consequences of that. And again, when you continue to hear negative economic data and it perpetuates the fear that there might be another leg down in the market, but that never happens. Again, we talked about how investors are classically trained to believe that there'll be a 20% correction every 2 years. Well, that just didn't happen for 11 years. Some people never got back in. In this example, 4 years later, when things finally started to turn around, somebody got back in. But the ultimate damage to a portfolio was already done. And in hindsight, it's really hard to look back and see, but mistakes are expensive.
Oh, for sure. So are you really of the mindset that a long-term investment strategy is the way to go historically? Like, do you ever participate in more short-term investments, not day trading, but short-term opportunities? Or do you generally try to always look 10, 20, 30 years into the future, really focus? Or do you change it up if it's like a Roth or a 401k, like something like that?
Yeah, it definitely depends on your time horizon. So, that kind of comes down to asset allocation. And actually, that's a great lead-in. Thank you. So we think about quantifying core capital as what you need to maintain your lifestyle, right? What you need to get you to achieve your goals. Certain clients we work with have what we call surplus capital, where they know that they can maintain their lifestyle. They're comfortable that if they live to 100, they have plenty of money. But then you have money beyond that can help you achieve secondary goals that you're able to take more risk with. So punchline is, being an investor is always the long-term game, but to your point, there definitely comes opportunities that present themselves. And again, we would call those dislocations, where the expected behavior of an asset class over a certain time frame that has been academically studied gives us the confidence to deviate from our core asset allocation to take advantage of something short-term. So I'll actually share a few examples of that we think might be interesting right now. Again, this isn't for everybody because everything depends on your own circumstances, and I could make no recommendation without knowing your situation, but I can tell you some of the trends that we're observing. But the importance of asset allocation and bucketing your money for your different objectives, long-term objectives like retirement, maybe near-term objectives like starting a new venture or acquiring a second home. You want to time your allocations out for achieving your goals in the time frame that you want to achieve them. So that's where it's important to do systematic rebalancing so that you can stay your course. Tax management becomes very important when we see this type of volatility. It enables portfolio managers and advisors to take advantage of tax trading. We think about keeping you in the risk level that you said you're comfortable with, and then certainly security selection. This whole pandemic has created so much disparity between companies and who had cash on hand and who didn't. One of the things we observed is that businesses in general have run very lean, meaning they don't keep a lot of inventory on hand because global supply chains work. Well, when global supply chains seized up because we saw what was happening in China and then Europe, whether you were able to get your parts or your inputs to your manufacturing or anything, again, we live in a global economy. Coming out of this, businesses are likely to rethink not just their relationships with their banks and their ability to get PPP and funding and applied for, but also how they run their balance sheets and how to think about having that rainy day money. So security selection, the ability to add value by understanding the difference between one company or another, has never been more magnified. There are 13,000 publicly traded securities out there, and there's over 200,000 private companies where there's a lot less visibility. The public market price is thinking right away. We're in an earnings season right now. We expect that to be reflected in the stock price immediately, whereas private market investments, diversifiers, if you will, there's much more inefficiency there. And so there's opportunity to generate more alpha. So I would say, and I'm not a portfolio manager, but our portfolio managers are certainly thinking proactively about that. De-emphasizing, real estate, you might be thinking more about residential or storage within the real estate sector versus investing in a new corporate building. So that's kind of a tactical shift. Costco, right at the beginning of this crisis, we all went to a bulk buying store and got toilet paper. Well, what's Costco's forward-looking return? We're always anticipating how a company will benefit from the trends and the secular trends that it's surrounded by, in addition to the fundamentals. And so, while Costco's done really well, maybe we were able to trim a position there and buy into a name that last year was too expensive for us to own, like a name like Amazon, which was always very expensive, and we just couldn't get comfortable with the price last year.
Right.
And this volatility presented an opportunity for us to lean into that name. So absolutely, there are tactical ideas within sectors. I think it takes somebody who's paying very, very close attention to participate in those. But at a higher level, when we think about asset allocation, there are a few ideas that we think are opportunistic right now that you can talk to your advisor about, you can talk to me about. I'll start from least risky to most risky from a standard deviation perspective, which is the metric we look at to measure the risk level of an asset class and how you will be compensated for the level of risk you're taking. But
do you mind if I interrupt really quick before you share the list?
Yeah.
The quick time check, it's 12:51. I know we were going to end at 12:45. We're going to wrap things up probably in the next 10 minutes for those of you that can continue to watch. For those of you that might have to drop, Eileen has given us permission to share these slides. So if you are interested in this information, council will be able to share with you. And I think you've mentioned that you're always available for additional questions and insights too, in case people want to chat more about this, right?
Yeah, absolutely. You can find me on LinkedIn, Eileen Ward, or my email is Eileen, EILEEN.Ward, WARD @Bernstein.com. I welcome the opportunity to continue the dialogue with anybody who's curious.
Cool, thank you. I just wanted to program that in here before anyone had to drop off.
Yeah, absolutely. And this is essentially the last slide. There's a few more interesting ones as people want to stay on, but we do have some ideas because there were some significant dislocations as a result of the way the markets worked. And municipal bonds, I mentioned, the historic default rate for municipal bonds is less than 0.2%. And they have a lot of flexibility because they have taxing authority. And so those tend to be on sale right now. And the benefit of tax-free income at the prices that municipal bonds are trading is very attractive. There's over 60,000 issuers. So again, you probably want somebody to help you pick which credits are attractive, but we do believe that municipal bonds, and again, the Fed has announced that they're going to provide further support for this asset class. So if you think of the Fed, they're a continued source of demand. So that should also improve the pricing of municipal bonds. Another area is the high yield credit market. There was tremendous dislocation here, and we haven't seen spreads get to these levels. So we talked about how treasuries are risk-free, and then you're taking on the credit risk of a specific company, right? Their credit worthiness, their ability to pay their debt. They borrow from investors and they pay their debt. Well, we saw that spreads went to 15%. So now they're trading a little bit lower than that, but typically when we see this type of dislocation, we often see, Jasmine, to your point, high yield, which is a riskier sector of the bond market, often outperforms traditional core equities when spreads are this wide. So to a tactical investor, this might be a 2 to 3 year play where you capture your returns and then you get back on track to that core allocation, right? And you wouldn't be risking a significant amount. You might be thinking, where do I fund this from, right? Because if you don't have cash right now, how could you afford to do this? Well, if we think returns in equities are going to be relatively range bound as we see the reemergence in the economy, but we know there's a timely opportunity within credit, then we want to fund from equities and take a little bit more risk in credit in order to try to capture those returns. And then once we feel that that trade has played out, make sure you get back to your more holistic sense of a portfolio to stay on track for the long run. Does that make sense?
It does make sense. And I'm wondering, for people that have set up Roth IRAs or 401k accounts, is this an opportunity for them, and maybe don't have the cash on hand to reinvest, is this an opportunity for them to look into those accounts and talk with their advisor of those accounts and see if they can potentially be restructured for potential short-term or long-term gains to react to what's going on right now?
Yeah, definitely. You usually, through your employer, have access to a financial advisor. Bernstein works with a number of plan sponsors. A plan sponsor is a company that provides a retirement plan to their employees. And for folks who have open architecture, you as a participant can go in and do it yourself. I'm not suggesting that you get out of the S&P and core equities altogether and go only to high yield, but if high yield isn't a portion of your portfolio, now might be an interesting time to trim a little bit from one area and get access to another strategy. Again, the reason people hire a financial advisor, though, is typically at the end of when that trend subsides, you want somebody to put you back in your core. So if you're doing it yourself as an investor in your 401k, set yourself a reminder for when you want to go back to that more well-balanced allocation.
Right.
But yeah, certainly an opportunity to think about, if you don't have cash on hand to put to work, how you can, within your means, make some of those adjustments.
Great.
Within the equity space, we would really encourage, and I'm going to share a slide here. We have a forecast, and we're revising this right now, but coming into the year, since the past decade had such generous returns, 13.5% annualized on the S&P, we didn't think that going forward the next 10 years was going to look exactly like the last. So our expectation was that we were only going to see, roughly 7%-ish growth in core equities, which is not as exciting as in years past. And we're probably going to revise this upward a little bit simply because of where we are in terms of valuations. And we're probably going to revise the bond returns down a little bit because with interest rates so low, the components of your return for fixed income is price appreciation plus coupon. The components for your total return for stocks is your price appreciation plus your dividend, and any currency appreciation as well. So we would expect to see a little bit more in terms of return for equities. So I want to share a trick with folks, because we talked about how being an investor long-term can be really powerful, and that if you do get back to work and you are able to continue to contribute to your 401k, that you're going to be buying in at lower levels than you did, say, in February. And so I want to just share a trick with everybody. You may have heard of it before, but it's called the rule of 72. And let's just pretend, for the sake of this, that our new forecast is going to be 7.2%. So if you take 72 divided by 7.2, that is the amount of years it takes for your money to double. So if you have $10,000 today and you're not going to contribute anything else, and you're going to make 7.2% because you're an all equity investor, well, it's going to take 10 years for that money to double. So in the decade, your 10 grand becomes 20 grand. Another decade after that, the 20 grand becomes 40. And another decade after that, your 40 grand becomes 80. So over a 30-year period, if you invest nothing else but stay an equity investor, you'll $10,000 is likely to become 80 grand. Now, I just bring that up because I think it's an interesting way to think about what encourages you to continue to contribute to these accounts. And coming into 2020, the IRS now allows us to contribute up to $19,500 a year to a 401k, and still up to $6,000 a year for an IRA or a Roth IRA. So if you total that up and everything that the government allows you to invest in a tax-deferred way, and again, tax deferral tends to add roughly 2% a year to your growth, because you get to put in more principal and it gets to grow, and you get to delay paying taxes until you're 72 years old, and you have to take required minimum distributions, because ultimately the government does need to get paid. They're not going to let you off the hook completely. But we would just encourage investing in a well-diversified, by style, by geography, by factor portfolio right now. Obviously, growth has dominated value, large cap has dominated small cap. And if you're just thinking about investing, there's a lot of arguments about reversion to the mean, and what hasn't performed for a while will likely make a comeback. Because those trends are kind of hard to predict and the pricing is different within each, we would just say invest in a more well-balanced portfolio that's factor and kind of sector agnostic. And then if you want to be really risky, China is an interesting trade right now. It hasn't suffered as much as other asset classes. The all China index is actually down only about 5.5%. And since they're returning to normal a little bit sooner, the last thing they want, because they have seemed to have improvement, is migration. So, we've de-emphasized things like casinos and hotels, but are playing on trends that participate in domestic consumption, which is what we would expect to see. So again, we might not necessarily believe every data point we see out of China, but as far as a demographic and economy, while it's taken its knocks, that is on its way to recovery. We also see that China is, they have A-shares, which is their home team of companies that they've only been allowed to invest in domestically. those are going to be put in the emerging, the emerging markets index. And so it was originally a 4% allocation in the emerging markets index. It's going to be 16% moving forward. That's a huge leap. Yeah. And as index investing has perpetuated itself, that creates a tailwind for China. So right now the valuations are 11 times multiples, and the earnings growth is 17%. So those are pretty rosy numbers when we said that earnings growth in the US was closer, to the numbers I quoted in prior slides. So those are some ideas right now. Again, talk to your financial advisor, talk to me, but we want folks to feel confident that this too shall pass, and whatever the return to normalcy looks like, we know it's been a painful couple of months, and that while we're all in this together, we do anticipate a recovery and a return to some semblance of normalcy. And I've been very, very encouraged. April was the best returning month in the stock market for the S&P since 1934. So I'm very happy to start seeing those types of headlines, and look forward to being a resource to anybody moving forward.
Awesome. Well, thank you for this presentation, for answering all the questions, for giving us this insight and this data. I think getting access to this kind of information is really special, and I think is something that people should not take for granted. This type of insight and data is not always completely available, and you're not always able to have it completely explained to you in the way that you've done. So thank you again for taking the time. Thank you for being a member of the council, for engaging with us, and for taking the time out of your day, especially with everything going on, to give us this lesson. We really appreciate it.
Absolutely. Thank you for the opportunity. Stay safe, everybody. Stay healthy. And I look forward to seeing you guys hopefully in person on the other side of this.
Absolutely. And again, everyone, this will be on njtc.org, this recording. We'll share the slides. Eileen is available if you've got questions, and we'll talk soon.
Absolutely. Stay well, everybody. Have a great weekend.
Bye, everyone.